Most people think retirement is a destination. They picture a tropical beach, a golf course, and a sudden magical absence of stress. But for millions of hardworking people right now, retirement is not a destination at all. It is a terrifying, rapidly approaching deadline that they are fundamentally not ready for. Earlier this week, I was reading through the comments, and one specific message stopped me dead in my tracks. The viewer wrote, "I am 52 years old. I have $30,000 saved. I feel completely paralyzed because I know I am simply too old to catch up." If you have ever felt that exact cold spike of anxiety in your chest, that quiet, desperate feeling that you have permanently run out of time, I need you to listen to me very closely. You are not out of time. But you are completely out of time for traditional, slow motion advice. I have spent the last few weeks rigorously analyzing the biggest financial regrets of people currently in their 60s and 70s. Today, I am giving you the retirement lifeline. These are the exact aggressive financial steps I wish I had taken sooner to completely bypass that late stage panic. And I need you to pay close attention to step 3. It is a structural banking secret that institutions deliberately do not advertise. It is the absolute fastest way to bridge a massive savings gap, even if you feel like you are starting a decade late. Before we can aggressively build your lifeline, we have to stop the bleeding. I call this phase the invisible bleed because it drains your wealth completely out of sight. When you are trying to catch up, the instinct is to desperately figure out how to make more money. But mathematically, the most powerful thing you can do right now is stop buying things that actively sabotage your future. The single biggest wealth killer for late starters is not the occasional expensive coffee. It is the quiet, devastating impact of high-fee mutual funds. If you have an old retirement account sitting with a traditional broker charging you a 1% or 1.5% assets under management fee, you are being robbed in broad daylight. A 1% fee sounds completely harmless, but over a 20-year compounding period, that tiny 1% fee will consume nearly 30% of your total potential returns. They take that fee whether the market is up, and they take it when the market crashes. Moving your money into low-cost, broad market index funds with expense ratios near zero is the equivalent of giving yourself a massive instant raise. The second bleed is lifestyle creep. As our income grows in our 40s and 50s, we subconsciously upgrade our lives to match it. We lease the nicer car. We buy the premium groceries. We absorb the raises into our daily existence instead of our future security. If we are going to fix this, we have to become actively ruthless about our cash flow. I want to pause right here. We are building a community of people taking their lives back. Drop a signal in the comments below and tell me the one specific useless expense you ruthlessly cut this year that actually moved the needle for you. Your answer might be the exact blueprint someone else reading needs to see today. Now that we have sealed the leaks, we move to phase 2, the catch-up strategy. If you are over the age of 50, the government actually acknowledges that you might be behind. The IRS allows you to make what they literally call catch-up contributions. As of right now, this means you can contribute an additional thousands of dollars per year to your 401k and your IRA above the standard legal limit. But knowing about the limit is useless if you do not have the free cash to actually hit it. This brings us to the hybrid debt method. The traditional advice tells you to pay off all your debt before you invest a single penny. The math nerds tell you to invest everything because the market returns more than your mortgage interest. When you are playing from behind, both of those extremes are dangerous. The hybrid debt method is a targeted strike. You isolate your toxic debt, the credit cards charging 24% interest. You attack those with absolute, relentless aggression because that interest rate is a financial emergency. But simultaneously, you must deploy a small, automated drip into your retirement accounts. Why? Because if you wait 5 more years to become entirely debt-free before you start investing, you lose the most critical compounding window of your life. Look at the math on the screen. Waiting just 60 months to start investing cuts your final retirement nest egg by nearly half, simply because the money had less time to multiply. You must capture your employer match, which is literal free money, while you hunt down your toxic debt. You split your resources, but you never pause your investments completely. This brings us to phase 3, the secret rung. This is the exact step I teased at the beginning of the video, and it requires you to look at the banking system completely differently. Most people view their credit score as a grade for how well they borrow money. Wealthy people view their credit score as a weapon to manufacture free cash flow. When you are trying to catch up on retirement, your biggest enemy is the interest you are paying to the banks. If you have $10,000 in credit card debt at 24%, you are bleeding hundreds of dollars a month just to stand still. The secret rung is executing a flawless credit optimization pivot. If you have maintained a solid credit profile, you have access to a tool banks hate when you use it correctly, the 0% APR balance transfer. Institutions will offer you 12 to 18 months of 0% interest to move your debt to them. The trap is that they assume you will just rack up more debt on the old card. They are banking on your lack of discipline, but we are going to use it against them. You move the high-interest debt to the 0% card. Immediately, the hundreds of dollars a month you were throwing into the furnace of interest payments is freed up. You do not spend that money. You immediately reroute that exact freed up cash flow directly into your catch-up retirement contributions. You are literally using the bank's own promotional capital to fund your retirement nest egg. You are taking the money the bank thought they were going to earn off you, and you are buying back your own freedom with it. It is a perfect, aggressive financial maneuver that accelerates your timeline by years. We have the theory. Now we need the execution. Phase 4 is your 90-day sprint. I do not want you thinking about the next 20 years right now. That is what causes paralysis. I want you to focus exclusively on the next 90 days. You have 3 non-negotiable tasks to complete. First, within the next 7 days, you are going to audit your investment fees. Log into your brokerage. Locate the expense ratios on your mutual funds, and if they are above 0.5%, you are going to pivot those funds into low-cost index ETFs. Stop the bleed. Second, within 30 days, you are going to log into your HR portal at work. You are going to increase your 401k contribution by just 1%. It is small enough that you will barely feel it in your paycheck, but it mathematically alters your trajectory. Third, within 90 days, you are going to execute the hybrid debt method. You will identify your most toxic high-interest debt, and you will investigate a 0% balance transfer to freeze the interest. You will then take the money you save and automatically route it to your future self. This is not about being perfect. This is about establishing a violently effective momentum. I want you to burn this concept into your mind. Retirement is not about how much money you made during your career. It is strictly about how much of that money you managed to keep and how aggressively you forced that money to work for you. You are not too old. You are not too late. But you absolutely cannot afford to wait until tomorrow to fix the structure of your financial life. You have to build the systems today that protect you tomorrow. Now, I mentioned earlier that capturing your employer match is critical, but there is a massive, highly dangerous misunderstanding about how that money actually works. If you are ready to secure your foundation and stop leaving money on the table, your exact next step is waiting right here on screen. Click through to my breakdown on why your 401k match is not actually free money and how it might be secretly costing you. I will see you over there. Keep building the bag.